In the previous module, we learned what risk is and how we can minimize our exposure to risk by diversifying our portfolio, buying stocks with a significant margin of safety, and by only buying financially healthy businesses. To determine whether or not a company is financially healthy, we have to look at their financial statements, which is what we learned so far in this module. However, what if management deliberately manipulates their reported earnings to make it look like the company is performing way better than it actually is? Because no matter how sophisticated your fundamental analysis and intrinsic value estimates are, if they are based on misstated figures, they are essentially worthless. Unfortunately, it is fairly easy for managers to manipulate earnings either upwards or downwards. In this lesson, you will learn why managers manipulate earnings in the first place, how they do it, what the dangers are for you as an investor, and how you can identify and avoid the so-called value traps, which is one of the most difficult aspects of stock picking. So why do managers manipulate earnings in the first place? Well, when earnings fluctuate, many investors get scared and start running towards the exit, pushing the stock price down. If management wants to avoid this, they can manipulate their reported earnings to smooth out these fluctuations. Another reason why managers manipulate earnings is because of the enormous short-term performance pressure from stock analysts and investors, who might expect unreasonably high earnings growth quarter after quarter. To meet these expectations, management can fiddle with the accounting practices in order to inflate their earnings and make them look better than they actually are. But there are accounting rules, right? So how is it even possible to manipulate earnings? Well, there are indeed accounting rules. They are called the Generally Accepted Accounting Principles, or GAAP. However, these rules allow some room for tinkering. This means there are legal ways to manage earnings to a certain extent. It's a gray area. Of course, there is a line a company can cross where it is no longer considered earnings management, but earnings manipulation, or even accounting fraud. The most infamous case of accounting fraud has been Enron, after which companies like WorldCom soon followed. Earnings can be manipulated in several ways. For example, companies can slow down depreciation to artificially inflate earnings. Depreciation is an accounting practice which spreads out the costs of long-term assets like a computer over their useful life, which is simply an estimate of how long you can reasonably expect to use that asset. To illustrate, imagine a tiny company which earns $2,000 per year in revenue and has no additional costs. However, it does buy a computer for a price of $1,100. These costs are not written off in one go, which would result in a net income of $900 in the year the company buys the computer. But instead, these costs are spread out over the useful life of the computer, which is around 3 years for this type of asset. If we expect that the $1,100 computer will still be worth $200 after 3 years, this means we need to spread out $900 over a useful life of 3 years. So we will report $300 depreciation per year for the laptop. This results in a net income of $1,700 per year if revenue stays the same. It is easy to see how this arbitrary method can be misused to make the earnings appear a bit higher. If management simply decides to depreciate the laptop over 6 years instead of 3 years, lowering depreciation from $300 to $150 per year, this way earnings instantly rise from $1,700 to $1,850, while nothing has fundamentally changed. You understand how tempting this is. Luckily, regulators are taking actions to minimize the use of this accounting trick. Other earnings management tricks include delaying when expenses are recognized, which leads to higher earnings now, but lower earnings in the future. Registering sales early, which inflates revenues, but which might turn out wrong if these sales do not actually materialize. Reporting made-up, non-GAAP figures to justify GAAP losses, which is what happened during the dot-com bubble. Overstating assets which are hard to value, especially intangible assets like goodwill. And the list goes on. It is not critical for you to know exactly what all of these things are. This is just to show you how many options managers have to manipulate earnings. Sometimes you think you have found the perfect investment opportunity, A highly profitable stock with little to no debt. You invest and the price starts dropping. You invest even more because now you can buy this great stock for an even better price. However, the price just keeps dropping, and then a news article appears which reveals that the company has been manipulating its earnings. Your entire investment goes up in smoke. A stock like this is called a value trap. The price of a true value investment is low because of irrational price movements, often caused by emotional reactions to temporary and solvable problems. The price of a value trap is low because of serious fundamental problems which are more permanent in nature. Sometimes you buy a perfectly healthy company which turns out to be a value trap due to unexpected events or long-term factors you may have overlooked. But sometimes value traps are purposely created by managers who manipulate earnings to make the company look more profitable than it actually is. To protect yourself from these situations, you need a way to identify cases of earnings manipulation. However, keep in mind that even the best investors in the world regularly buy value traps. One of the most difficult aspects of stock picking is knowing when you found true value and when you found a value trap. But making mistakes is part of investing. Investor Peter Lynch said that in this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. I will now give you some ways to identify earnings manipulation and avoid buying value traps. There are 2 major scientific models to identify companies which might experience financial troubles in the near future. I will only describe these models here briefly, but you can find a more detailed explanation, including formulas, in a document which is part of this module. The first model is the Altman Z-score, developed in 1967 by the finance professor Edward Altman. His Z-score is based on 5 financial ratios, which can be easily calculated from the financial statement data of a company. The Z-score is used to predict whether a company is headed for bankruptcy within the next couple of years. While the Altman Z-score is widely used, this model has its limitations, since it was originally developed to work for US manufacturing companies only. The goal of the second model, the Benesch M-score, is not to predict bankruptcy, but to identify companies which are manipulating their earnings. The Benesch M-score was developed in 1999 by Professor Mesut Benesch, and he used 5 variables to predict whether or not a company is manipulating its earnings. His experimental results showed the model was able to correctly identify manipulators 76% of the time. So again, while it might be interesting to have a look at the Benesch M-score, it is by no means perfect. Also, it does not work on financial companies, but I suggest you avoid these overly complex businesses anyway. You can easily look up the Altman Z-score and Benesch M-score for a company on the Summary tab of GuruFocus.com. Then there is a book written by the financial analyst Hewitt Heiserman called It's Earnings That Count. Heiserman points out the flaws of the current financial reporting system and offers a way to identify earnings manipulation before a stock comes crashing down. He argues that his system would have been able to predict the downfall of Enron and many other manipulators. How? Well, by creating 2 alternative income statements, which counter the flaws of the reported GAAP earnings. The process of creating these alternative income statements is quite elaborate and outside of the scope of this course, so if you are interested, I suggest you purchase the book. It's a great read. However, Heiserman also offers 30-second versions, which are less accurate but way easier to use. He suggests to look at 3 years of historical financial data and then calculate 2 ratios. The first one is called defensive profits, which actually is simply a different word for free cash flow. Just as we learned in the previous lesson, we calculate this by taking cash from operations and then subtracting capital expenditures. If defensive profits, so free cash flows, are negative or decreasing while earnings are growing, this might indicate earnings manipulation. This is something we also discussed in the previous lesson about free cash flow. The second ratio is called enterprising profits. We calculate this ratio by taking earnings before interest and tax, or EBIT in short, and dividing this by total debt plus total equity. If enterprising profits are higher than 18%, then there is a high probability that the firm is creating value. If enterprising profits are below 18%, the firm is potentially destroying value and should therefore be avoided. While none of the above-mentioned methods will protect you for 100%, they can still help you avoid making some costly mistakes. To further protect yourself, listen to Warren Buffett and always look for companies with trustworthy, shareholder-friendly management. And be sure to read the footnotes in a company's financial reports, because the devil is in the details. Unfortunately though, it is often the case that despite your best efforts, you only find out who is swimming naked when the tide goes out. To summarize, to determine whether or not a company is financially healthy, we have to look at their financial statements. But management sometimes manipulate these statements to make a company look more profitable than it actually is. No matter how sophisticated your fundamental analysis and your intrinsic value estimates, if they are based on misstated information, they are essentially worthless. Managers manipulate earnings to keep the stock price high and to meet analyst expectations. The generally accepted accounting principles allow several legal ways to manage earnings to a certain extent, which are sometimes misused. A value trap is a stock which appears to be a great investment at first, but is actually experiencing serious fundamental problems which are permanent in nature. The price of a true value investment is low because of irrational price movements, often caused by emotional reactions to temporary and solvable problems. Even the best value investors in the world regularly buy value traps because it is very difficult to identify them. There are two major scientific models to identify companies which might experience financial troubles in the near future: the Altman Z-score and the Menaish M-score. They are both useful, but not perfect. Hewitt Heiserman developed a method of creating two alternative income statements which counter the flaws of the company's reported earnings: the defensive income statement and the enterprising income statement. Shareholder-friendly management is important because honest management is less likely to manipulate earnings. Finally, always read the footnotes of a company's financial reports because they can reveal important details. Congratulations, you finished another module. In the next module, the real fun starts, because you will learn how to find attractive stocks to invest in. I'll see you there.